Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You're with us here on a fresh new edition of Trading Hour. The market is not doing all that well. Nothing as compared to what we saw yesterday by close. The Nifty is down only 12 points, so that is flat. But look at what's happening on the mid and small cap indices once again, and you get the idea. I mean, actually, around 11 or so yesterday, same time, you had a situation where the Nifty was, again, something like this. I mean, 10, 12 points here or there. But the market breadth was looking extremely poor. And what happened through the course of the day all the way into close was that the Nifty followed the broader markets down, and we had a meaningful cut by the time we shut shop yesterday. So, I mean, you know, the market breadth is bad. It's a similar kind of situation, basically. It was a little worse off by 11 yesterday, but this is not good either. 1250 lower and about 700 stocks are higher, and the Nifty is flat. So let's see if we get a repeat of what we saw yesterday. I just want to highlight three numbers actually. From the market rebounded, right? I mean, we fell from the all-time high on the Nifty, mid-cap, small-cap indices, all the way to the lows of, on the Nifty, it was about 99.50 or so. That was March of 2018. And then we rebounded back. And then we sort of fell and then we rebounded. The last swing high that we got was on the 13th of June. That was about 10 or 11 trading sessions back. I mean, the recent high, not the all-time high, but the recent high from where the market started falling. You just look at the numbers. Nifty is down only 2%. I mean, actually, from the all-time high, the Nifty is down only about 4.5%. You look at the mid-cap and the small-cap indices, the damage on mid-cap index is 5.5%. The small-cap index has lost almost 9% over the last 10 trading sessions. So, again, just putting the numbers out, which put in perspective the pain that the broader market is seeing, which may not be evident when we look at the Nifty itself. Welcoming in my colleague Ekta into the show as well. Ekta, hi.
Hi, Prashant. Well, we can't really say the same about what's happening with the rupee, considering that we have breached 69 on an intraday basis, and that is the first time that we're seeing 69 on the rupee ever. So maybe we can just pull that up. It has pulled back, but I just want to put it into perspective that, in the past 5.5 years, yes, we've depreciated around 8% on a year-to-date basis, but just look at the resilience of the rupee as compared to what we've seen in the past 5 years. And I want to factor in the fact that we saw a taper tantrum in May to maybe the end of 2013. And compared to that, just look at how we've done. Russian ruble down 100% in terms of depreciation, South African rand over 60%, Turkish lira 160% and 21% in 2018 itself. So compared to that, the rupee is depreciated around 25%. And that is the kind of resilience that we need to factor in and also look at when we see the rupee depreciating 8% in 2018 and hitting record lows of 69 rupees against the dollar. But nonetheless, let's get talking about the equity markets then. Sudarshan Sakhani joins in to discuss that. Sudarshan, hi, over to you. What are you recommending on the Nifty, considering that we have recovered around 27 odd points from the day's low? Would you call it resilience, and what kind of calls would you take?
Yeah, good morning again. See, there are two undercurrents in the Nifty. The first is something I have been suggesting, that you buy July puts. The intermediate trend has turned down and we are looking at a correction again on the downside. That's a positional trade that will last for many days and weeks, not just today. That's the first undercurrent. And the second is, what is today's view? Today it seems the markets are oversold on a short-term basis, and I would suggest buying the Nifty. Please understand that volatility can be quite extreme thanks to the FNO expiry, but the view is to buy the dips rather than sell the rallies. That's the view. Buy the dips for the day. Independent individual stocks have other, themes. Mid-caps are getting the brunt of this decline. In fact, as Prashant was just explaining, and that's going to happen. This is not, we are in the middle of that decline for mid-caps. So by the time this decline ends in the next 3 or 4 months, mid-caps will be, well, battered beyond shape, unfortunately, many of them. So Siemens is a short sell. JSW Steel is a short sell, which is surprising because this was a strong stock, but mid-caps don't look at strong and weak stocks. Markets become very general in them. And the only buy is Cipla, part of the more upbeat pharma pack. So two short sells, a buying opportunity, and well, a downtrending market.
Okay. All right, Sudarshan. Well, we have a couple of Twitter queries for you. Vemaji holds 3,500 shares of Adani Power at 24 with a 3-month view. What should he do, he or she?
Well, I'm so sorry, but I don't have any optimism in Adani Power. Power stocks are going through a deep correction. So in 3 months, nothing is likely to change. You'll have to have a lot more patience. So I can't give a sell or a hold, command or a suggestion, but I can say that nothing will happen in 3 months.
Okay, we've got one more question. Anand holds 50 shares of Take Solutions at 264 rupees. That's the cost. He wants to know whether he should hold or sell. I mean, I think Take has started to come off a little bit in the recent last couple of days. Stocks at about 228. The all-time high was 308 rupees. His cost is 264. Sudarshan, what should he be doing?
Well, he should sell. There's lower levels coming here. As we've just explained, talked about mid-caps, so there's no sense in holding. There's a small loss, get out. There'll be more opportunities later on.
Okay, all right, Sudarshan, we're going to let you go on that note. Thanks very much for joining in and taking us through those strategies. We have Shubham Agarwal also joining in from QAPP Securities to tell us what he's strategizing. Shubham, over to you, stocks as well as index.
Good morning, Ekta. So I'll start with the index first. As we know that Nifty and Bank Nifty has been oscillating for quite some time, and that's why the June expiry is expected to be just flat. But in July, we do expect that some movement will come on the either side. And the good thing is that if you're trading options, even if you expect an either side movement, you can still participate and make money out from that. So the first strategy is a strategy on Bank Nifty to go for a long strangle, where we have to buy the 26,500 call and the 26,300 put. On a strategy level, the target profit would be 8,000 rupees and the stop loss would be 4,000 rupees. And this is for the 5th July expiry. The second call is on SBI. So as we know that SBI sometime back broke above the 270 resistance and it saw a decent up move, and right now it's in a pullback mode. So I believe that the formation that is there today is quite positive, and we might see SBI seeing a halt at the current level and it's ready for an up move. So we can deploy a low cost strategy, that's a bull call spread for the month of July. We have to buy a 265 call option and sell a 270 call option. The target profit would be 5,200 rupees and the stop loss would be 2,500. And lastly, the third strategy is on Sun Pharma. So we have seen a decent up move on Sun Pharma, but a couple of days back we did see a strong spike getting formed on the upside, which is indicating that the uptrend might come to a pause and the stock might enter an oscillation with a support at 540. So bear put spread is recommended for the month of July. The trade would be to buy a 560 put option and to sell a 540 put option. The target profit is 6,000 and the stop loss would be 3,000.
Okay, we speak again. Thanks very much for those trades. Appreciate you joining in right now on those trades. Nilesh Shah is Managing Director at Kotak Mahindra Asset Management, and he's joining us right now on the phone line. Nilesh, good morning. Thanks very much for taking out the time. I mean, your thoughts on this bit of a rough patch that the market is going through. You know, for all the sort of refrain that, well, it's looking awful, etc., the Nifty is down just 4.5% from the all-time high. This at a time where the mid-caps and small-caps, etc., have done a lot worse. I mean, the small-cap index in the last 10 days has lost about 9%. Of its value, about 5.5% of the mid-cap index. The Nifty in the last 10 days is down 2%, and as I said, about 4.5% from the all-time high. Your thoughts, Nilesh?
So last year's small-cap index delivered almost 50% return. That's like 3 years return together in 1 year. So if you have enjoyed 50% return last year, then you have to be ready for taking volatility now. So to some extent, this correction is because last year there was a very, very sharp run-up. The second thing is purely valuation. The small cap and within small cap, micro caps and mini cap stocks were trading at a valuation higher than large cap. Based on the last year's performance, momentum money, immature money chased in these stocks, and they were all taken to levels which were far, far away from their fundamentals. And now that correction is occurring. And we think the momentum-driven small cap, micro cap, mini cap has still room to go down. But some of the quality small and mid cap stocks will start making a process of bottoming out over next 60 days. And one should clearly look at their portfolio. They should avoid momentum-driven stocks where prices are way ahead of their fundamentals. But one can definitely look at quality mid-caps and small caps in this carnage. Not that you are going to get any quick gains, but you have to catch the falling knife over next 60 days in this small and mid-cap portfolio.
How would you, quality stocks were also driven by large momentum. You said momentum-driven stocks can go down even more. Quality stocks will bottom in the next 2 months or so over a period of time. I mean, how do you differentiate?
Essentially, companies whose accounting policy you can't understand, companies where managements are giving guidance for next 3 years, companies where auditors are running away halfway. There are so many, flashing points which are available if one reads the balance sheet. So do read the balance sheets to figure out which company is quality, which company is momentum. Look at the track record of the promoters in the past. If they are coming up like mushrooms in monsoon season, then please avoid them. Stay with those promoters who have delivered return over a period of time without corporate misgovernance.
Sure. So Nilesh, so what would you recommend to, say, a retail portfolio, a person who has a retail portfolio where all of his stocks have fallen, say, 70% plus, or many of his stocks have fallen 70% plus in 2018? Should he book out from those mid caps entirely, take the loss and reinvest in the quality mid caps that you're talking about? Is that the strategy that they should adopt in order to circumvent the kind of pain we're seeing in mid caps?
I mean, my recommendation is that if he has to depend upon my advice, he better, seek my professional help as a mutual fund manager. If you have to depend upon third-party advice to figure out the stocks which we have bought, have they gone below their fair value or are they above their fair value, then please don't go direct into the stock market. Stock market is not meant for some time pass. It's a serious investment.
That point's taken, Nilesh, but many stocks with good promoter backing have also seen this kind of fall. So I'm sure they went into it thinking that these stocks would be resilient and they would have those kind of governance standards as expected, but that's not what came through in 2018. So in such a scenario, what would you recommend?
So I have realized over the last 25 years that when you go into momentum-driven stocks, there is very rarely a possibility of making money. I mean, in Ramayana, definitely in our mythology, Valya becomes Valmiki and ends up writing Ramayana. But in stock market, very few Valya becomes Valmiki. And of course, when they become, they give great return to you. But it's far better to have compounder in your portfolio rather than Valya becoming Valmiki.
Okay. Okay, well, Nilesh, moving away from equities, do you think that 2018 or the second half is going to be tougher when it comes to the macros for us as compared to what we've seen, say, even in 2017 with the risk of Brent crude, and now we have the rupee at 69 also?
Undoubtedly, you have raised a very, very important point. Whole of calendar year 2017 was Indian cricket pitch where you could have gone and scored run. You could have played a test match like T20 and you would have still ended up scoring runs. But 2018 second half as well as 2019 first half will be more like South African pitch, where even in T20 you'll have to play like a test match. As you correctly mentioned, the rising oil prices are impacting our current account deficit, reflected into currency almost touching 69. The same oil price is also reflected into inflation if government passes that to consumer. That will get reflected into fiscal deficit if government doesn't pass that to the consumers. In order to protect currency, interest rates have moved up. The 10-year yield is flirting with almost 8%. A combination of rising oil prices are reflected into deteriorating current account deficit, inflation, fiscal deficit, and interest rates. And clearly on top of it, towards 2019 beginning, we'll start pricing in political uncertainty. So undoubtedly, as you correctly mentioned, second half of 2018 and first half of 2019 will be far tough from a top-down point of view.
Okay, Nilesh, just a quick word. By the way, there's news on Gati, and I saw IKEA on the flash, and we'll just pay attention to that and maybe try and get Gati on the line as well. Just a quick word on what's happening with, this entire China thing. So Chinese stocks are down 20% from the high. The currency is going down fast. I think in the recent last few days, it's lost about 3% or so, 3% plus. Last time this happened in 2015, a 3.5% fall. We had US markets which lost almost about 10-11% in 5 trading sessions flat. Your thoughts, and what do you think that the Chinese situation has as an impact on US and other markets?
So my guess is that the transient impact of global tariff war will be definitely adverse for our markets. But how we manage that tariff war will determine what will be the long-term impact. Let me give you the most positive view. Like that, childhood story of a monkey weighing the roti between 2 cats and eating up the whole roti. Can we take advantage of China and US tariff war? We can go to US and tell them that, look, you have been importing almost $200 billion worth of textiles from China. We make cotton, we make yarn, we weave the fabric, and we are supplying cotton to China, yarn to China. Why don't you allow us to supply fabrics and garments? If we can do that, our $17 billion garment exports will go up significantly. And instead of selling cotton to China, we will be selling ready-made garments to America. You can imagine what will be the value add. The second thing is to go to China and say that, look, we are running $52 billion trade deficit with you. Why don't you reduce that trade deficit? Otherwise, we'll also have to do similar thing which America is doing to you. And yesterday only I read a tweet of Chinese ambassador to India where he has removed or he has made easy for Indian goods to enter China on some 8,000 odd products. I don't know how much of that is gimmick and how much of that is real, but I think we have a reasonably solid position with China to negotiate about reducing the trade deficit from $52 billion. Our trade deficit to China is higher than America's trade deficit to China in percentage of GDP. So if we can take advantage of opening up Chinese market and replacing China in American system, then that will be beneficial to Indian economy. Else, otherwise, we'll end up getting hurt without any fundamentals.
Okay. All right, Nilesh, we're going to leave it on that note. Thank you very much for joining in and talking to us about the fundamentals of the market. So that's Nilesh Shah, and you'll get to hear him through the day. Welcome back. Well, we have Manisha Gupta with us to apprise us of what's happening in the commodity and currency space. Manisha, over to you.
Thank you. Oh, crude, yes, because it has been very, very volatile, and we've seen 3.5% of gains yet again come in overnight markets. Of course, Asia has seen some profit taking, but very rightly so, deservedly so, because we have seen nearly 7 to 8% gains in last 5 or 6 sessions itself. We did see US crude oil prices go all the way up to $73.05, and that has been the highest level since November 2014. And that is where we have seen some profit taking kick in Asia right now. While on one side, of course, the markets are looking at higher supply from Russia, Saudi Arabia and US. And on the other side, you have supply crunch coming in from many other OPEC members and Canada, the unplanned outages. All of that really seems to be adding up to the prices. The geopolitical concerns, the global uncertainties, especially with US asking for halt of Iranian crude purchase. That, of course, has been leading a lot of premium to the prices. But at this point in time, markets also are reacting to the fact that the US weekly inventories have seen a biggest draw in 2018 till time. So there is a lot of events, a lot of fundamentals to go on with, and we are trading on the higher side of the range when it comes to crude. The other thing, of course, has been the Indian rupee, and we've been discussing it since morning. The worst performer in Asia, down 8% in this year. That is yet another thing that you have to keep a look at when you're looking at Indian commodity prices in sense of calculation there. 0.5% of a decline as we continue right now. Of course, there has been some PSU banks intervention And that is the reason the rupee has come off its day's low of 69 or thereabouts. Navneet Damani now joins us to talk more about that. Navneet, hi. Even before we go to commodities, it is the currency space which asks for attention. In the futures, how have the volumes been? Where do you see a more movement coming in?
Well, we've seen record volumes on the future in yesterday's trading session. Both NSE and BSE have hit record volumes, and I think the volatility is what is driving the volumes at the moment. Option market is very well developed in terms of currencies, and crosses as well as domestic pairs are seeing good traction. And with the sharp depreciation, now we think that there will be a lot of import covers coming into hedging their positions, and that will also push some kind of volumes on the exchanges, not only the exchanges but push the prices even higher.
What is your sense on, are we looking at prices going beyond 69? Because that is something that most people feel would only a spike and not really a sustainable level.
Well, we've seen this happening for the third time in the last 4 or 5 years, that it's come close to 69 levels, and this time more so it's supported by upcoming elections, weakness in our current account deficit and rising crude oil prices. Sustainability on the technical front, if you see, if closes about 69 level for a few days, then probably we are headed even higher. On a very short term basis, it could spike towards 70, 71 also, and that is purely on the technical side. But yeah, some bit of cool off can happen, because we've seen the sharp rally in the last 3-4 sessions, so a minor pullbacks could be opportunities to go long once again.
How are you looking at the crude oil prices then? Because while of course yesterday saw some strong gains, and we haven't been able to keep up on that follow through buying today, but with the kind of buying that we already have seen on charts, how much further on the higher side do you see the charts moving?
We've seen crude oil prices sharply rising in the last 3 sessions. They are up about 7%. Along with the factors that you mentioned, we've seen massive drawdown in inventory. Also, Iranian concerns regarding US imposing a ban after November, and also sharp backwardation that is prevailing in the market of over $1. So until this backwardation narrows, or the spread that you've seen between Brent and WTI, which was about $11 2 weeks back, is now close to $4. If this all continues, then we are seeing prices even going higher, and 72, 73 is where we can see some kind of breather, but eventually 76 cannot be ruled out.
Navneet, just a quick word on gold. I mean, with all that is happening in terms of equity markets, etc., selling off, and generally this perception that risks are quite high, trade war and whatnot, gold as a safe haven should have done well, but it's essentially at lows for the year, I think. What's going on there?
Well, even I am as puzzled as you are. The safe haven buying story continues, but it's not impacting gold and silver prices at the moment. So much of the worst news seems to be factored in. The pain seems to be over, but the party is not yet started, so we'll have to wait and watch. Technically, if you speak, that 1290, 1280 was a very strong level which shouldn't have been broken, and now price is sustaining well below that. 1250 could be on cards, where we might see some eventually buying happening, or some bit of base formation happening, but until then another 300-400 rupee downside could be possible in gold from here on.
But I can give you one important tip here, Prashant, in case you want to buy gold, and even as it's trading at 1250 in the global markets, Indian markets are at a $10 discount. So you could go out and buy at 1240 because nobody's buying.
Thank you for the advice, Manisha. All right, thank you very much, Navneet, Manisha. Appreciate you joining in, and that's essentially the commodity segment as always. We take a very quick break. We come back and we report on markets once again. So we got a 30-odd point cut now, 10,640. I mean, this is quite similar to what we saw yesterday. As I began by saying, as the day progressed, what happened yesterday was that the Nifty, which was flat, started to follow the broader markets on the way down. And today, let's see if with the same thing happens or not, but advanced decline is 1370, 1380 stocks, about 600 stocks higher. So in favor of declines. We come back and we stick with markets. Ashwini Gujral is going to be with us with his thoughts on the index, what to do in terms of trade.